Okay, next topic is what is growth investing? And why am I typing so badly today? Growth investing is a type of investment strategy that focuses on buying stocks in companies that are growing rapidly and it's expected to continue growing the growth at a faster rate than the overall market. The goal of a growth investment is to purchase stocks of companies that have high earnings growth potential and the ability to generate substantial returns over the long term. Okay, growth investors typically look for companies with strong revenue and earnings growth as well as high potential of future growth. So this is the key sentence here. When you're talking about growth companies, you're not looking really a lot at the current numbers and the current growth. You're talking about the longer term growth. And this is where a lot of the Tesla believers will come and say, hey, Tesla might look very expensive today, but when you see what is the potential of growth in the future, that's what you're kind of paying. And they have stocks like Amazon or stocks like Apple to kind of Apple, not so much. Amazon has been a stock that has been pretty much losing money for years and years and years, pretty much in the entire period of the 2000s and in the 2010s. Amazon was only focused on growing and not making money. So if you were a value investor, you would say, hey, it's super expensive, it's not making any money, why would you buy it? But it wasn't about the current situation, it was what Amazon can become. And obviously now we know that Amazon is pretty much owns the online retail sector. Not only that, it has multiple other sources of income like its cloud division, so on and so forth. So that's what growth is. So if you're thinking about growth investing, don't just look at the current rate of growth, but is that rate of growth going to be the same or even higher in the future? Okay. These companies may be in an industry to have a unique business model. Growth stocks can offer higher returns than the overall market, but they may also be volatile. They're absolutely more volatile and come with a higher degree of risk. Definitely knowing this before deciding to kind of growth invest is pretty much the basics. Again, it's important to know that the growth investing is a longer term strategy as the goal is to hold those stocks for several years and benefit from the growth. Okay, very good point here. So if you are expecting the company to grow, don't expect the stock to reflect that in a month or two or even half a year or a year. So it needs time. Like Tesla stock, Tesla was doing pretty much what it's doing right now, pretty much from 2010 all the way to today. But Tesla stock was not doing very substantially anything better in the 2000, like 15, 12, 13, 14, 15, 16. It only kind of took off after when they, let's say, started making the Model X was, I think, the pivotal moment when they announced that car. They started going higher, and then from that, the Model 3, the Model Y, and they have been rocketing ever since. But point is, you have to wait for the growth. It's these investments, even though in value investments as well, but here even more so because you're buying into the future. With Walmart value investing, you know what you're buying. With, let's say, a Roblox, which is an online game for those of you that don't know, and its stock is highly volatile and it's a growth stock, we are expecting growth. We're expecting that number of users and hours engaged to grow over years and years. And if you're invested in that stock, then that's what you believe. Although, again, very expensive stock. It's also important to analyze your portfolio and consider. Definitely diversifying portfolios of growth investing is definitely important because there's high risk here. So kind of diversifying your portfolio in multiple companies that you truly believe in, and even if some of those companies don't make it, let's say a company like Tesla makes it, then the gains from that company will offset some of the losses that you might have. So that's pretty much the case in point for diversification, but especially with growth investing, because it is a little bit of a gamble because you're betting on the future. And if you, let's say, choose 10 stocks, 10 growth stocks, very likely that some of them won't make it, or won't make it, will still make it, but won't have those super returns or the growth that you are expecting. And then the stock may plummet because you are paying a premium. With all growth stocks, especially today, especially in the market in 2023, you're paying a premium for growth stocks. So they're not trading on a P multiple like in 2021. Not only a PE, which is price to earnings, companies were trading on price to revenue. So they were trading way more expensive than even their revenues. But it was the future growth that was put into place. So that's why you're pretty much betting on the future. And again, diversifying here is especially important because that way, again, as I said, some may be winners, some may be losers, but hopefully the winners kind of make make up for the losers. Okay, let's give us examples. Can you give me some examples? And I'm not gonna ask for growth investing because, as I said, this is super smart. So hopefully it will know. Sure, here are some examples of companies that are often compared to growth stocks. See? Super smart. Technology companies, companies such as Apple, Amazon, and Microsoft, which have a strong track record of growth in the technology industry and other considered growth sectors. Okay, so we got earnings last week. Apple did miss on the earnings, but it pretty much stock still went up. Apple, I don't know how much of a pretty much at this point a growth stock it is. It's pretty much a value play because even when people are scared, they go into Apple, and that was proven on Friday because even though they missed, people still bought Apple stocks because it's considered a safe haven. Amazon plunged pretty much 5-6%. So it is still a technology, it's still a growth company. And I'm not gonna focus on that. I'm gonna focus on Microsoft, which is the biggest shareholder in this thing. Okay. This is not financial advice. I'm not recommending for you to buy or not buy a stock. But if you are amazed at what this thing can do, this is the owner right here. Microsoft, not to mention stuff that Microsoft has, like the Azure Cloud, Windows, Word, and everything else. Now it owns this, and I think this is pretty much the future. We'll see if there's other chatbots like this, but so far right now there's no comparison to this. Healthcare companies. Healthcare companies are normally considered value companies, but this is not really healthcare. This is Biogen, Moderna. Biogen and Moderna are considered biotech. So there's healthcare and there's biotech companies. So keep that in mind. And these are biotech. Pfizer, yes, now with the mRNA technology, we can put it in that camp. But realistically, that's a healthcare, I would say. But these are more biotech. And again, growth companies with high risk because they are experimenting with all kinds of new future ways of treating us, or the pretty much the mRNA technology, making technologies that will revolutionize healthcare. So keep that in mind. So I would say biotech here, not healthcare, but yes, it is in the healthcare sector. Consumer goods. This is normally considered value as well. Yeah, I wouldn't put. We had Coca-Cola in the value camp, so now giving us in the growth. Okay, so that's why we need still to kind of look through the results that it's giving us, because yeah, Coke is a good company, but I wouldn't say that it's a growth company. Nike, no. P&G, okay, so I'm starting to see a pattern here. Only it's kind of repeating the stocks that was giving in. That's kind of making me think whether it doesn't have a lot of data on this front. And I think on purpose, though, let's put it out there that this thing has so much information, so much data that they could easily have given it a lot more market data, market information. But as I've said in other videos, I think if they did that, then Bloomberg would not have a job anymore or be a company. Emerging market companies, okay? Companies such as Baidu. This is Baidu Do. This is in China. Tencent, that's also in China, and Alibaba. Okay, so these are all tech companies in China that are based in a rapidly growing emerging markets and are leaders in the relative industries. That is very correct. And these are pretty much tech companies that are super undervalued. But the main reason why they're undervalued is because they're in China and there's massive fears, especially from US investors, that about the Chinese economy and how like it's an open market economy today, but it cannot be in the future. And that's why these stock like Alibaba, especially trading in the 80s or 90s, even now in the hundreds, it was a stock that was over $350 at one point, and it's a giant. So definitely undervalued, but the point is, it's not here. There is company specific risks and economy specific risks. And with Alibaba, the company is doing fine. It's a kind of economy specific risks with the Chinese economy being run by a kind of communist regime, and US investors do not like that. So that's why the price of Alibaba or Tencent or Baidu stocks are where they are. So keep that in mind. So you might think that their value, and they're both value and growth, but there's not a lot of a willingness for big players from the United States to get into these stocks. And I don't know why the Chinese are not propping them up, which they can easily do, by the way. So that's also a very good question. It's important to know that these companies or stock prices can be improved by a variety of factors, including market conditions, economy. Yes, we've heard that before making any investment decisions. Talk to your advisor. Obviously, having a financial advisor or making your own decisions and not listening to YouTubers on what to buy and not what to buy is very good common sense. Okay, so that's really good on this strategy, and let's go to the next one.